Director and Managing Director of KCB Tanzania. Karibu sana. But we also have Mr. Nicodemus Mkama. Mr. Nicodemus Mkama is the Chief Executive Officer of the Capital Market and Securities Authority in Tanzania, CMSA in Tanzania. So we will start with Professor Lemma. Professor Lemma Senbet will take us through a presentation as a main speaker for this topic, financial institutions, efficiency, and survival in times of crisis. Prof, you have 20 minutes. You are most welcome. Yamani, karibuni, oh, half an hour. Okay. Sijui nadhani watu wamekaa upande mmoja, and then we have very empty spaces there, and you know, turning your head around is really difficult, but I hope Prof will be fine. Welcome, Prof.
Thank you. I'm assuming there are excellencies in this room. So, Your Excellencies, distinguished guests, Yambo or Hambo or Mambo, Abari Hazabui. Yeah, so this is homecoming for me. As I'm at the University of Maryland. I've been in the US for a long time. I took a leave of absence for 5 years to come back to the motherland and give back in some fashion. So I was privileged to head the African Economic Research Consortium, ARC. ARC is very important for Tanzania because it was the home place, the birthplace. Tanzania is the best of the birthplace. And that was a consortium of members from around the globe. They decided that they should have a knowledge institution that is intended to conduct research and deliver that to policy. And the first African head of ARC was a Tanzanian, was Benno. And in fact, there was actually a string of Tanzanian heads of ARC. I was the one who ended up interrupting it. Right? So, but let me also mention that Benno is very close to my heart. He is the one who introduced me to ARC. One day, he showed up in a conference when I was presenting something, and then he came up to me. I didn't know this guy. He said, "You need to come to Nairobi." So, of course, I never left. And when I took over ARC, the first thing that I did was take the biennial, the flagship activities that actually bring together early career African researchers and resource people from around the globe. And it goes on for a week. I said, I'm going to take us to Tanzania. I took it Arusha. Arusha was my first biennial. So there is another reason that I feel strongly about Tanzania. Is really because of the topic that I'm going to discuss. I remember when Benno invited me, he wanted me to write a piece on the stock markets in Africa. You know, I didn't know much about that. 25 years ago or something. But it occurred to me that these markets, especially stock exchanges, were very thin, illiquid, and kind of balkanized. They are there, but they are not producing information, very limited price discovery. And then when I was mapping what's going on in Africa, things have changed. You know, we always talk about the crisis, the dark of Africa. But what I've noticed is the incredible movement, the good news, and Tanzania is at the center of that. So when I think of the need for technology-enabled solutions, mobile banking, and fintechs, and then of course what I saw today was being privileged to be a part of another revolution, TIPS. So, so basically my talk is not supposed to be country specific, but I'm making an exception, okay, for Tanzania because I'm in Tanzania now. So, so this is a roadmap of what I was going to say. If I get through this, then I may have a bunch of slides. So I think that I wanted to start with the hopeful continent. There are good news out of Africa. And then, of course, we have shocks. You know, we have shocks. And yeah, we have shocks and headwinds. In 2023 was particularly difficult year. And then we saw also post-pandemic recovery, including Tanzania. But if you look at the totality of growth, on a per capita basis, it's still low. So we grow, but the population is also growing. so when you come back into per capita basis, we have still many miles to go, despite the fact that we have very positive outlooks. So there is always a temptation when we have challenges to react and come up with solutions and then kind of ignore that these shocks could come back again, right? So really, one of the things I wanted to emphasize is apart from reacting to current challenges, we should also think about building back. And that's why resilience is so important. And then in building back, you know, we've been talking about debt for a long time now in Africa. So you think that, you know, what is the relationship between debt, you know, financial efficiency and resilience? But the fact that this debt is overhanging, you know, it's overhanging. And despite the fact that projections have been positive, still we have this debt servicing cost and substantial distress, and it is taking up space from dealing with some big issues as climate solutions. So it's a big deal. And then the private sector, when you start talking about development financing, is missing in action. So really one of the things that I'm going to push for is scaling up the private sector solutions. In fact, the more I thought about the good news about Africa, the issue is not that we don't know the ingredients, but we need to scale up. We need to speed up. You know, we have, for instance, AFC, TFTA. You know, we need to have a speedy implementation of them. So in terms of building back, in terms of resilience, it's important to have new products, like the one that you have today. Climate finance startups, they haven't really begun showing up that much in Africa, okay? But we have experience in fintechs. So we have entrepreneurs, right? So there are private sector guys. That's why I feel like the private sector really should be at the center, because they can actually innovate. They can do stuff without, so sometimes they're ahead of the game. The fintechs, you know, they're not invented by the government, right? These are private sector activities. And I mentioned earlier about this thinness, the liquidity of markets, including banking. We need to have integration. We need to have a scale. And then what I noticed is that even in that score, things have improved. Things have, and I'll mention that more specifically. So when you integrate, when you scale up, you also position yourself to be integrated into the global financial economy. And of course, given that we have so many headwinds, so many risks coming up, it's also imposing challenges on regulating digital financial services. You know, climate risk-sensitive assets. That's not easy. So I think one of the things that I'm going to put a lot of emphasis on is capacity building, because that's what ARC is about. We need capacity building everywhere. We need to strengthen capacity building in risk management, data and information capacity, digital capacity, talented financial manpower, public finance and debt management. So for instance, if you look at the debt, the data and information capacity, you have heard about credit ratings. You know, we have rating agencies. And despite the fact that you see some positive performance outcomes, a lot of African countries are, well, undergraded, right? So And the question for me is not to simply say these guys are biased. I think it's also incumbent on us to be self-reliant and make sure that we have appropriate database, appropriate information, proactively engage with so the fact that we have gaps here in our own house is also contributing to credit ratings. Okay, so you remember there was a Time magazine. Remember there was a hopeless page. I didn't include that. When the hopeful came, two entities beat Time magazine and The Economist. And people actually in the US ask me, because they have seen this, how is that possible? By the way, it's not accidental. It is not accidental. It is a result of extensive economic and financial sector reforms over the years, and empowerment of private sector, and then emergence with stock markets reform, and basically what you did today, okay? All that, and then ARC, by the way. So informed policy making, you know, it took me a while to recognize. I learned that when I was at ARC, is a factor of production of growth. Let me give you an example. You could have policy formulation that's misguided. You will destroy value. It aggregates into economic performance. And if you do it well-guided, and evidence-based, you create value. And that actually adds to economic performance. So I believe that informed policy making is I'm going that way. Yeah, good. Yeah, this is what I said. So now we enter shocks. So we have COVID, Ukraine, and then debt crisis, climate change, huge financing gap. For the remaining part of my talk, I'm going to focus on debt crisis, climate, and huge financing gap. Now, so as I mentioned earlier, we have growth. And there is some kind of divergence between resource-rich and resource-poor countries. Again, the IMF came up with GDP performance, and the biggest issue here is GDP per capita. So we have had shocks, we have had headwinds, and we have recovered some. But then, the question for us now is how do we build back so that we become resilient and efficient? And let me give you a case of banks. Efficiency matters. And I'm going to talk about traditional efficiency, where you have input efficiency, you have output efficiency, you have profit efficiency, you have allocation efficiency. Is that right? So what has been shown in terms of evidence is that the more efficient banks are actually able to be more resilient. And that much is clear. And what the implication of that is, in regulating, you are going to look at the metrics of banking efficiency. And in fact, it's also an equation where you can actually see the survival of the fittest, right? So there are banks, there are institutions that should not be surviving, right? Now, this in the crisis moment, there could be a revelation that some cannot survive. So as I mentioned earlier, tackling public debt is so important because it's a deep, very, very overhang. It actually interferes with our efforts to be resilient. And what happened was there was a debt buildup post-HIPIC. If you recall HIPIC, there was massive restructuring, and then all of a sudden, economies began growing. And for the first time, African countries began accessing international credit markets, arm's length, arm's length. That is bright and dark. The bright is that all of a sudden we are in the international markets. The dark is that they got built up, and when interest rates start picking up, the debt servicing costs start going up. So people always look at debt buildup in terms of debt to GDP ratio. That is a very insufficient metric, right? Insufficient metric. In fact, countries like Japan have close to 200. And most African countries, maybe maximum is 60. That is insufficient because what it masks is the debt servicing cost, which is associated with the degree and debt servicing capacity. So you have to see the totality of that. So it's really important that, given this stress, if you look at this picture, it's a very interesting picture. If you look at 2013, 40% of African countries have low risk of risk. 40%. Is that right? Now come back, 10 years since, 2022. All of the countries, okay, all the countries, okay, either they have moderate or high risk of default. The guys you always hear about are the ones on the upper echelon. So what is really puzzling is that I mentioned earlier that growth is showing up. The projections seem to be positive, but on the other hand, we see that there is not just that build-up because in fact many countries are being rationed out of their markets. Right? So this is really, really big challenge. And there is the G20 common framework that's intended to come up with orderly restructuring. It turns out that it has become dysfunctional. Earlier I was telling you about the missing action private sector. Private sector actors have been very difficult to come to the board. And then you have the bilaterals like China. So this was very hopeful when it came up, but then on the other hand, so far it hasn't really worked out. So as you can see, countries are becoming distressed. Yeah. Zimbabwe, Zambia has the first default, and then in December 2023, Ethiopia became the latest African country to default. So we're actually facing real danger. The danger is that this ballooning external debt will have adverse impact on job creation and climate finance and on the objectives of this conference. The whole idea of strengthening the financial sector, think back, resilience. This will be effective. Now, so one of the misfortunes of this is that it is distracting us, taking away our capacity from dealing with big emerging issues such as climate. Climate is an incredible opportunity. We are the richest energy continent in the world. So Africa is not poor. Africa is rich. The issue is that if I suppose there's a stock market, okay, where Africa is listed, okay, and if you are going to trade, you know, the unlocked value of Africa is huge. And climate, given that there is now a need for renewable energy and so on, it is an incredible opportunity. You know, the paradox, as you know, you have heard about this, that, you know, we don't really produce much in terms of emissions. We get most. And so, but nonetheless, it's going to pose physical and financial risks. And for regulators, risk management for climate-sensitive assets is really, really important. And so, the opportunities lie with renewable energy, sustainable agriculture, climate-smart infrastructure, and climate finance. And climate finance is one place where there is a big debate going on globally. Okay, and so, and this being recognized by AU, there was a declaration. The question now is who's going to pay for this? Who's going to pay for this? There was a large climate financing pact summit in Paris, if you recall. And the global financing needs are in the order of $3 trillion. And there also has been promises by the global partners, but they are okay. So this is where the dire financing situation for climate finance for Africa. So the continent received US $13 billion annually, 2020, 2022, and that represents 20% of global adaptation finance. And then if you look at East Africa, East Asia, and Pacific region, 45%. And what's happening is that people tend to focus on mitigation. And in terms of finance, adaptation is actually losing ground. So I think I'm going to so in terms of finance, official development finance is small, and then of course bilateral does lion's share. But then they pronounce all kinds of bold initiatives, but do not get delivered. So the question is, how are you going to bridge the gap? You go back to private sector. Private sector here is missing. So there is a need for private-public partnership, and as we know, in the private arena, you have equity markets, debt markets, entrepreneurship, climate startups, and climate finance. And climate finance startups, I haven't really seen many of them in Africa, but I think this will be an opportunity. And then, of course, blended finance, that's public-private partnership. And bridging the financial development gap. So bridging the gap for financing requires bridging the developing gap of finance in Africa. So So a few years ago, we did a study. The study was to look at how African countries stack up against the benchmark financial development line. So what we did was we ignored Africa for a moment, looked at peer low-income countries, ran all kinds of regressions, and came up with a line. And then we projected this on Africa. So basically, we measured African financial development gap. And reforming finance is now tantamount to bridging that gap. And what as I mentioned earlier, there have been improved debt and intermediation across the continent now. There's improved financial access. So things are actually moving up, and including Tanzania. And these are the African stock exchanges. And there are close to 30 stock exchanges. And sometimes it feels like people are competing to set up a stock exchange. Countries are competing, as like they're competing for national airline. Okay? So starting a stock exchange, if there's no exchange of stock, it's like a museum. Okay? So for stock market to be functional, it has to produce information. There should be price discovery, and there should be improved governance, and that is lacking. It's really the functional perspective that we have to take. And so these markets, for the most part, unless maybe the more advanced one, they will have a hard time to survive. Okay, so in 1 minute, I'm going to close with some hopeful signs. I think again from the private stock okay, I think I'm going to ignore the slides. I'm going to talk with those slides, and then I'll be done. And this is a very provocative slide, as you know, right? And it says the future of fintech is tough. It really is. And you guys have begun showing up. And climate opportunity is so huge. That is an incredibly huge, fertile ground for fintech. By the way, fintech is not just the future for the globe, and Africa being the basis, but it's also a start. It's also where it began. So the idea of climate startups, fintechs, innovation, that is a way to bridge this gap. But let me point out that we should pay a lot of attention to capacity building. Okay, as markets become complex, sophisticated, we need a commensurate, capable, talented financial manpower. We need to integrate these markets. And there are integration efforts actually happening already in West Africa. And some of you have heard about this the African Exchange Link Program, which is really it's almost like a game changer. And we need to make sure that the capabilities are also for risk management. Risk management has actually expanded. We have now, climate, and then also, it also imposes challenges for regulation, regulating digital financial services, and regulating this fast-changing terrain challenge. This is important. Now, we know this is also one way to become more self-reliant. And we will have to reduce over-dependence on external guys. I think the external guys that we should be using should be for technicals. For instance, G20. G20 can actually provide, even that this new US-Africa strategy, a lot of that is on the private sector, digital transformation, and a number of entities which are actually linking up with Africa. So, so the message that I'm saying here is that we have come a long way, and we have faced all kinds of shocks and headwinds, and we have actually shown resilience, and we have been recovering. But given the staggering magnitude of the problems that we're facing, we need to do more. In fact, we need to leapfrog, basically. We need to start thinking outside the box. The private sector actually playing a very important role, and then also partnerships within the region for market integration and consolidation. Yeah, thank you.
Thank you very much, Professor Lemma Senbet. I think Professor has actually covered so many things, yeah. But I think I like the way he has tweaked the topic of the presentation. I think we had financial institutions, efficiency and survival in times of crisis. But you can see that the presentation that Professor Lemma has just finalized had a topic called Perspectives on Long-Term Viability of Financial Institutions, which I think I like even more, because even as much as we are talking about efficiency and survival of these financial institutions in times of crisis, I think this is all about sustainability. It's about long-term existence of these financial institutions. And I think Professor also covered how do we get there. He talked about capacity building, many times in his presentations. Capacity building in risk management, capacity building in areas of importance nowadays, data management, information, technology, and all that. But most importantly, I think he has also talked about capacity building of our people. How are we capacitating our people to ensure that, they are able to cope in this environment that is ever changing. Professor also covered a little bit on the stock markets, yeah, and the fact that, the stock market should really play their role, price discovery, providing information, and if they are not doing this, then are they museums, yeah? I think this is what Professor has covered. But also the future of fintech in Africa. I think all this is really about sustainability and long-term existence of our financial institutions. If we are not able to compete in this market where you have fintechs, they are coming up with products and all that, do we compete? Do we partner with them? This will all just ensure our long-term existence in this market. Now, I think before we move into the panel discussion now in terms of the questions and the answers, I can see people are really just, quiet, sitting, relaxed. Can we stretch a little bit? Yeah? Can you stand up, please? I think after that we will have, a better discussion. Let's stand up. You just follow me. Get some space. Okay, now let me move to the panelists and ask them a few questions. I think my first question goes to Mr. Philip Madamombe. Mr. Philip, what are the strategic steps that can regulators take to maintain efficiency and stability of the financial sector during crisis? And we know that you come from Zimbabwe. Can you please share experience, particularly from Zimbabwe, but also, you know, anywhere in developing countries? You have 5 minutes, Mr. Philip Madapo. Welcome.
So, good afternoon, everybody. Governor, thank you for inviting the Reserve Bank of Zimbabwe to this very important meeting. Being a regulator, I think it's important that I start by reminding each one of you that the overarching objective of bank regulation is to foster financial sector stability and build resilience to shocks. And when you do that, you are providing for sustainable source of credit, of savings, products and payment services for the economy. I think this is very critical for us as regulators and for the bankers here. And again, as been said, there's been a lot of research that has been done which shows that a stable and efficient financial system is very critical in promoting and sustaining economic growth and development. We have also seen, I think, through the effects of COVID that the financial sector is kind of de-linked from the development agenda. And this is an area that we also look at. And then in terms of what has been happening, where economies and financial markets have in the past been experiencing different crises and of varied dimensions and proportions. But if you look at the COVID-19, I think this one is the economic shock of all times. And there are lessons to that. So we see that post-COVID now, and in the wake of these continued global uncertainties and shocks, banking institutions are expected to contribute to sustained recovery and growth of economies. So the expectation on the banks is more than before because of the experience that has been, that we've gone through. But also as we look at the crisis, we also look at it in the negative. But I always want to look at it to say that crises themselves can catalyze positive change if we harness them effectively. So when you look at how we do things in Zimbabwe post COVID-19 now, if I have a discussion with my CEO of a bank, I say, Mr. CEO, can I have a risk register? Then they give me a risk register. Mr. CEO say, can I have an opportunities register? There's nothing. So what we are now insisting on is look at risk, but I also want to see an opportunities register. So that's the opportunities that arise, which we must leverage on. So specifically in terms of some of the issues that we regulators can do in terms of fostering efficiency, we can reduce the spread of systemic risk and assure continuity of financial services through various areas. One of the areas is enhanced supervision of banks. And when we do that, this must be characterized by on-site examinations that are intrusive and incisive in nature, so that we are able then to identify emerging risks early, and then we can take corrective action. What we did in Zimbabwe is that when COVID came, our focus was on two C's: continuity of operations and credit flow. And because of that, we then recalibrated our supervisory approaches and methodologies to deal with the uncertainties that was unfolding. We did undertake comprehensive thematic reviews, especially on asset quality, considering that borrowers were in distress. We also now held regular virtual meetings with management and also insisted on board members to be part of those regular virtual meetings. We also relaxed some prudential norms on asset classification and so forth. And we also learned that sometimes extraordinary times require extraordinary measures. There are times when you need to think beyond conventional ways of bank supervision. We looked at that and did that, particularly with a view to avert the build-up of loan defaults. We requested our banks to work constructively with their borrowers. But at the same time, we noted that there were certain borrowers that were cutting across the banking sector. And these were NPLs. And then what we then did was that we said, instead of us insisting on the banks to work with those obligors who were not paying, I called them one by one to my office and told them that you have a borrowing this bank and this, and because of that you are non-performing, and what you are going to do is what you are going to kill the whole banking sector, because we have been hit before in terms of NPLs. And what that did was to unlock, you know, a lot of the impasse that was between them and the banks. So it was unconventional in that we were now dealing directly with the borrowers. But if we had not done that, I'm sure by now they would not have, you know, paid, and it meant a lot in terms of, you know, the stability of our sector. Off-site surveillance, stress testing needs to be key surveillance and early warning too. So during COVID, we then changed our shock levels. For example, the major shocks on credit risk was about 42%. We then moved it to 78%, just to test the resilience of the banking sector, particularly given the unpredictability and disruptive effects of COVID. Coming to capital, I think one of the strategic steps that regulators should take is to regularly review adequacy of capital standards and to require and insist on existing shareholders to inject capital. In it, you may also request for, you know, to think about, you know, consolidations and so forth. So in Zimbabwe, what we've also been doing is that we are strictly enforcing the legal requirement that a bank can only pay dividends after its board and management have assessed and are fully satisfied that after that payment, the bank will still remain compliant with the various capital ratios, including ensuring that it has sufficient economic capital to underwrite more business, and more importantly, to look into the future around issues of possibility to absorb losses. We also think that regulators need to develop sufficiently comprehensive regulations on domestic systemically important banks as part of risk-based supervision. We have done that, and we have 5 of our banks that are DSIP, and we've, you know, we request them and them to have additional, you know, capital buffers. And then one other important factor that we are building capacity on, that we think is very critical, relates to the need to conduct business model analysis of banks to ensure that they are strategically aligned with the bank's core competencies, its market opportunities, and risk management capabilities, and that will enhance efficiency and sustain competitiveness within the evolving landscape. And as well, regulators need to ensure that banks are prepared for the unexpected. In this regard, banks should be required to prepare detailed and plausible living wills, which are called recovery plans ahead of crisis. In Zimbabwe, we also do this, and I'm sure all regulators also do this, and we also then require banks to submit to us annually. And then business continuity management is very critical. The business continuity plans must be activated during a crisis to ensure maintenance of critical operations without significant disruption. I think guidance around business continuity, third-party, sourcing is very critical as well. And then on the part of regulators, we need to develop and operationalize contingency planning and crisis management framework. This is essentially a blueprint for identifying potential risks and implementing preemptive mitigatory measures, and also establishing very clear procedures for crisis response and recovery. So we also noted that crises are often accentuated by weak governance structures, and there's need in that regard to have progressive boards. These are boards that add value to the institutions and not passive boards. And one area that I think it will also be covered, but it's very critical for regulators in this field of bank supervision, is that there's growing consensus among us regulators that institutions that have sustainability objectives present lower business and systemic failures. So in Zimbabwe, in order to ensure strong, sustainable, inclusive, profitable, climate-proofed and crisis-ready institutions, we have been resolutely focusing on the adoption of sustainable banking practices in the banking sector. And 14 of our 19 banks are currently participating under what we call the Sustainability Standards Certification Initiative being run by the European Organization for Sustainable Development. In terms of that standard, there is a clear link between sustainability and profitability. And where you have banks that are profitable, they are now able to deliver impact to the society. One important aspect relates to technology. Banks can navigate volatility by harnessing technology. And technological transformation can be a source of long-term profitability for the banks. So it's important for the banks to adopt technology and to embark on reasonable, innovation that is responsible. And on the part of banks, let me share, because I was talking more on the regulators, but also on the part of banks themselves, institutions, they need to execute new offerings better, faster, and more efficiently in order to survive. And as the consumer preferences change, banks may require to focus on user outcomes and user experiences instead of products. I think the preferences are changing. And then there will be need for the banks to broaden their revenue base without bloating or ballooning the balance sheet. The source and credibility and sustainability of earnings in this regard becomes key. There's need for earnings that are generated through sound business models, where earnings targets that are in place do not lead to short-term profits. So if you focus on short-term profits at the expense of long-term profitability, you are bound to weaken your institution. In conclusion, madam, there is need for a paradigm shift from short-term thinking to long-term termism if banking institutions are to survive and adapt to the fast-changing world. Meanwhile, as regulators, we must continue to recalibrate our regulatory and supervisory processes so that they remain fit for purposes. Madam, I had a lot to share, but in the interest of time, I will stop here. Asante sana.
Asante sana. Asante sana. I think very, very, very relevant comments coming out there, but I really like the fact that why do we only look at risk registers? Yeah, let's start looking at opportunities registers as well. But I think as he finalized his presentation, long-term view, sustainability, that's the only thing that will ensure that these financial statements, these financial institutions continue to survive for a long term. But I think maybe just to add, because we were looking at measures that were taken by the Reserve Bank of Zimbabwe, I think similar measures were actually taken by the Bank of Tanzania during the COVID-19 pandemic. And maybe just to mention a few, the Bank of Tanzania here also, really adopted a number of relief measures that helped to cushion the economy, but also to support the banking sector in Tanzania. They reduced the statutory minimum reserve ratio, but also they reduced the discount rate. They reduced the haircuts for borrowing using government securities, but also there were quite a number of regulatory flexibility, particularly on restructuring loans and facilities for borrowers that were facing challenges during the pandemic. And I would say that the governor is here, the banking supervision teams are here. These measures really, really helped the banking sector in Tanzania. I think when the global revenues for the banking sector were declining, actually the revenues for the banks in Tanzania were growing, double digits, both in 2020 but also in 2021. So I think a round of applause for the Bank of Tanzania. That was, brilliant work.
I'll try to be within 5 minutes, even as I know some have exceeded a bit. The beauty with what I was presenting is that it's being chopped piece by piece since morning when Mkama Rais was presenting. And so it's leaving me with, now I'm going to cherry pick what I wanted to speak so that I don't appear repetitive when it comes to the audience. And I think in terms of the question and how we organize, I look at it from multiple fronts. For instance, we really need to understand the nature of this crisis we are talking about, because in a way there are, in my view, two types of what we talk when we look at what is happening in the banking sector. For example, when you have a situation where there is the sector or the economy is solvent, then we really don't term that as a financial crisis. That is actually a financial disruption. And I think when you have that situation and you are dealing in a banking sector, it's only panic which makes us not to deliver what we are supposed to deliver. Because if you have a bank, for instance, struggling with some liquidity here and there and can access liquidity from the central bank, you can really not start talking about crisis. That one we term as a financial disruption. And clearly even what is happening on FX today in our markets across the emerging markets is exactly that. Now, a financial crisis is when you have a situation where the sector is insolvent and it becomes really difficult to even know what is happening tomorrow. And that takes me to my next question, which now says, how do you deal with that in multiple setups or economies? If you look on that situation, if you have a developed economy, the typical economies are the AAA rated ones, that crisis is easy to maneuver around. And I'm not saying easy in the context of absolute easiness, but it becomes easier to manipulate as opposed to the others which I'm going to mention. So if, for instance, today you have a crisis in the likes of the US and co, you would see, because of the transparency, the ability to the development, the level of their stock markets, and various other markets that are easy to, there is ways to maneuver around. But if you go to the second category, which is now the emerging market countries, Latin America, part of Asia, and Africa, it becomes more difficult. Because you are now faced with a situation where there is a crisis, and everyone is trying to get away. And you can get examples of, you look at these economies, even now, you look at Nigeria, currency depreciated 70%. Look at Argentina, peso 50%. Look at our neighbor Kenya, over 30%. And it's not yet really a fully crisis like I defined. But it's because also of the ability which Professor said about how our markets are able to absorb shocks. For example, our stock markets, if you look at the capital flight, and this question of capital flight when it comes to develop these emerging markets is a huge problem. There is no way you can talk about limiting. Of course, you can limit. We noted that during the Asian crisis, Malaysia did that, and ration and decided to take those kind of actions, but they actually did. But then the third one comes into planned economy. When you have a crisis on the centralized economies, that is what you don't see. I think you would hear very few talking about crisis in China. You see the property market in China is going haywire, left, right, and center, the largest one collapse. But because of the inefficiencies, and I'm not saying efficiency here, because the government sector gets support on deposits and liquidity and all that, and the transparency is not clear, then you have that typical arrangement. But then now that takes me down to what happens during crisis time, so that we can now figure out what can we do now as banks and how do we navigate that to make sure that we continue to survive and continue to do our roles as banks. And you see, during crisis, what normally happens is panic. And when there is panic, then greedy fits in. When greedy fits in, then you have issues like bank runs. Depositors and bank runs you categorize into two. You have depositors rushing to pick their deposits, and you have those lenders you have given open lines coming quickly to utilize those lines because they don't know what is going to happen tomorrow. So you have double crisis. Depositors chasing their money out, and then those borrowers who you have given money coming now to utilize those lines. And there is absolutely no way, even as big as you be as a bank, to sustain that pressure. And all of us know what happened to Washington Mutual. That was the largest failure in history. We're talking about 307 billion US dollar size of a balance sheet. That is 800 trillion TZS. And within 10 days, depositors withdrew 17 billion. Now, even if you have what do you do to have someone who is taking 17 billion? So later I'll talk about now how we are going to organize, because even when they take that money out from this one entity, it's not going anywhere. It's going to another entity. So it's moving from A to B. So someone who is being hit by 17 billion, there is another one who is getting 17 billion. So how are we going to organize to ensure that we harmonize that? And that comes to that point of making sure that we ensure that we restore back what we call stability in terms of confidence. Because what we normally say in banking is that when the banks cannot do their jobs right, and the Vice President said in the morning, if we don't do our things right and monitor our borrowers correctly, depositors will monitor the banks. And that's what you would see. If you are not doing your right stuff, then you have challenges on lending. You start to have your own problems. Depositor monitors you by doing the right thing, taking their funds out. And that's why you see during crises, if you see like the 2008 crisis, lending went down by 47% across, and I'm talking about big economies. But Madam Ruth talked about the measures we took during COVID. And if you look at the European Union, large banks, actually there were some positivities from the crisis in that non-performing loans reduced from around 5% to close to 3%. So that takes me to that issue I was trying to say earlier, that what do we now have to do to navigate a situation like this? And whereas there is really no one medicine into this, and I don't think there will be a book which will tell you, because of the different market bases and economies, someone to tell you if you get this, then you can do this, and then you can get out. Some of them are not conventional. You can actually, it's hard work. It comes, we sit. So one is that we have to make sure that we communicate enough ahead of time. Don't hide. And sometimes when you have a crisis, even as a bank, and we run these banks, you will go in that phase of denial, thinking things will go away. And if you read history after the Silicon Valley Bank collapse, today you will hear blames about, they didn't say it on time. Banks, first, if there is a challenge, the first medicine is to be transparent, because depositors who are now expected to be monitoring us if we are not doing our right things, they are the ones who decide whether we survive or not. So giving them information ahead of time and consistently communicating is one of the solutions. But again, another item which as banks in situations like this we need to do is to do selective lending. Not all sectors will be affected by a crisis on an equal manner. Even when you look at COVID, there were sectors which were doing very well and some were not doing well. So there is that question of figuring out which sectors we should continue to support during crisis. And those sectors, if we extend and increase credit, they now would make us continue to make money, and in that way even lower our NPLs for those who are not doing well, and at the same time they will give us now time for us to maneuver around the crisis. So selective lending is one of them. But again, there is how do you diversify the portfolio? And I think we're talking about credit modeling and all those kind of things. We need to be in a position where we can now say, look, this is a crisis. How can we diversify to sectors which will help us to continue to improve? And in doing that, then you can now also be able to have multiple areas you lend. Because one thing is, if you have a crisis and you stop, say for example, completely lending, you can actually increase, create challenges and exacerbate the crisis. In that, those borrowers who are supposed to get, say, working capital, if you don't give them the default, they become NPL, and then your capital still is going. There is a thin line between continuing to lend for the good sectors in a diversified manner versus stopping altogether.
Finalize now, please.
Now, Madam, I'm going to that. And now the final one, which is kind of summarizing, is that we will require a complete, honest and working relationship between the multiple sectors. We will have the regulator on one side, and regulator, we talked about it. We will have the banks, which are the financial institutions, including the insurance companies and all the financial sector. We will have the customers who are going to agree with us that if we collapse, they will also fall with us, so they have to be with us. And then we will have the government. In times we talk about, and I'm happy some of the parliamentarians are here, we talk about private sector. Private sector allocate funding or support to areas where they see benefits. They're not going to be there to say kuna ujamaa. No, they will come when they see there is value. So there is an area where the policymakers should clearly chip in and take charge. And you see Credit Suisse. If you read, I think probably if you read news, you will know that few months before the takeover by UBA, the government was already planning to take it down. But there were some arguments, you cannot take private sector, blah, blah, blah. So we are saying that in specific conditions or situations, the government should chip in and do the right thing. The US did that when they guaranteed the depositors of Silicon Valley and Co. They took off Fannie Mae, Fred Mac, nationalized. And so that is an area also which we need to work clearly to ensure that we now support the system, because the interest here is the system. If we can revive the system, create confidence, I think we'll be out of woods and things will go. Thank you, Madam.
Thank you very much. Yeah. I think Mr. Cosmas talked about, being selective. Yeah. The question is, how best can we organize to finance economic activities during crisis? I think he talked about being selective, and I think for me, I would say, in particular crisis period, I think we need to be very, very strategic in terms of how do we distribute the lending activities, yeah, inclusive and high impactful sectors. So, for example, agriculture, yeah, industries, and all that. And I think you talked about the government chipping in, and the Bank of Tanzania is here. We know that during COVID, actually, the Bank of Tanzania introduced a special agri-fund of 1 trillion, whereby banks actually can borrow at 3% and on lend with rates that are below 10%. So I think these are some of the mechanisms that the Bank of Tanzania helped us very much. But I think the other question that we should be asking ourselves is how do we mobilize funds, yeah, in times of crisis? How do we mobilize funds? Because I think in times of crisis, actually normal deposits may not be easy to find. Normal deposits could be a challenge. So how do we get those funds? And I remember during COVID, some of us actually borrowed from DFIs. Yeah, we had the likes of IFC that came with, where they called the COVID facilities. Yeah, I think in times of this, you actually have some of the DFIs that come with those facilities, and certainly as financial institutions, we should also be looking at those. But climate risk, and I remember Professor Lemma also covered in his presentation. So from climate risk, I think there is opportunity to borrow significantly, particularly from impact investors. I think the sustainability bonds that we have issued, for example, Jamii bond, Kijani bond, CRDB, they all brought in significant amounts of money in the country, and mainly because, we have impact investors that, probably they are not even looking at returns. They are looking at returns, but also they are looking at the impact that they are bringing into the society, the impact that they are bringing in the world. These are called impact investors. So I think these are the things that we also should be looking at. So Cosmas, thank you very much. I think you touched on these comments very well. I think let me move to Mr. Mkama now, the capital markets. What is the role of capital markets in enhancing financial sector stability? And if you have any useful use cases, particularly from Tanzania, I think we will be thankful to hear those. If you can be strict to 5 minutes, please. Thank you.
Thank you, Lucy. I'll be strictly to 5 minutes because the issue that I wanted to talk are the one that you have already spoken about. So, capital markets facilitate sustainable long-term financing in times of crisis. And this is done in a number of ways. One is through issuance of medium-term note programs like the one that was done by NMB, where we approved a medium-term note program worth 1 trillion, and also for the one with CRDB banks, where we approved a medium-term note program worth 780 billion. This provides opportunities and avenues for banks and financial institutions to get funds that are long-term in nature instead of relying on short-term deposits that might not be readily available during times of crisis. And by raising these funds, which are long-term in nature, they facilitate these banks and financial institutions to enhance their capital adequacy. Because what has been noted is that during crisis, what is really very critical is rising level of non-performing loans. So once you have rising level of non-performing loans, when the regulator comes in, the first thing what they do, they start doing the review of your portfolio and make an assessment, and they will do a provisioning. Now once they do the provisioning, that means your capital adequacy will be affected and therefore coming down. Now if your capital adequacy is low, that means your ability to lend will be lower. But again, if you have a high level of non-performing loans, that means you will be facing some liquidity squeeze. Now with the capital markets, we provide avenues for banks and financial institutions to access long-term funds. And in the recent 2-3 years, we have witnessed a welcoming trends by banks using capital market. And I was quite happy when Professor Lemma pointed out that the good news are now coming from Africa. I think this is evidence with what happened in Tanzania, where the first green bond was issued in our market, and it is listed on the Dar es Salaam Stock Exchange. And this has been the first green bond with the biggest ticket size to be issued in sub-Saharan Africa. So this underscores the point that have been raised by Professor Lemma, that now good news are coming in Africa. But I'm quite happy that on my right hand and on my left hand, I'm engulfed by CEOs who have done and facilitated issuances of this instrument that has been successfully and has put Tanzanians on the international map for innovative, long-term sustainable finance. NMB issued the first gender bond in sub-Saharan Africa. It is listed on the Dar es Salaam Stock Exchange, but is not close, but also is close listed on the Luxembourg Green Stock Exchange. So this has helped to profile not only NMB, but also the capital market as well as the country, where we are now able to attract not only investors who are looking for returns, but investors who wants to make impact in the financial system. So if we have this kind of instrument coming to the market, that's how you are able to address challenges in the financial sector. I was quite happy when I was reviewing the IMF report on the role of capital market during crisis. I came to realize that capital markets are actively used in times of crisis as relative to what happens in times of good times. Because post-pandemic, more than 66% of the issuances for sovereign was issued post-pandemic, but 32% was also issued by corporate bonds. So you could clearly see how capital markets play a pivotal role in facilitating banks and financial institutions in times of crisis. So I would call upon all players in the banking sector to work together with intermediaries in the capital market so that you design instruments that are going to facilitate addressing issues of liquidity, capital adequacy, but also on the cost of funding. And with that, we can clearly make a very big difference. Kenya Commercial Bank issued the first Sharia-compliant Sukuk bond that has been issued to the public and now is listed on the stock exchange. That has been a groundbreaking transaction that has helped other financial institutions also to design and come with Sharia compliance products. We have seen Amana Bank doing the same, but also that has opened doors to financial institutions like Iman Finance doing quite a number of issuances. So we really need to tap opportunities that are in the capital market to address these challenges during economic times. Thank you so much.
Thank you very much. I think that was very, very clear, and I don't need to repeat. I have one final question, and I think Mr. Cosmas, if you can help us respond to this, then I will open up for the audience to also ask some questions to the panelists. Mr. Cosmas, how can banks enhance sustainability in the evolving technological advancement, climate change, and economic headwinds? I think this is really what we have been talking all along, yeah, in terms of sustainability in the environment that we are operating. If you could use 3 minutes, I think that will be appreciated so that we can also open to the audience to ask some questions. Thank you.
Thank you, Madam Ruth. Again, and I think this topic, when you talk about sustainability and also issues of climate changes and technology, I think it's important to understand that in this context, actually there are opportunities. If you look, for instance, of technological advancement and the evolution from the banking industry, from the ages where we didn't have MOBI and all that, there were a lot of worries in terms of, you know, what would happen to banking industry and all that. But today, we are very proud to say that we are operating as, you know, we are complementing each other to drive the sector ahead. This afternoon, I was talking to Geoffrey. He was telling me about the penetration of banking into Tanzania. I think 22% is for the banking sector, but if you include the MOBIs and co, then you are talking about 70 something. I'm not sure about the statistics. But that is all good news when you look at technological development. And the beauty is that now with technology, we don't really, it can happen anywhere. It's not about developed word. M-Pesa is our neighbors, they did it. And we are seeing a lot of new innovations coming in, and you can mention them. Some are raising, some are not. So for me, I look at that from the banking side. For us, we need to just be keen on ensuring that we partner with the right partners, we harness the right technologies, and we put in place proper controls, because that is the most important thing. But before we adapt any new product or any new system, proper controls are in place. Now, in terms of climate risk, and we are seeing a lot of shifts and talks here and there in terms of financing fossil fuels and all that. But if you look also, and I was in Juba the other time, and I saw some of these investors putting a huge amount of solar, plant, which is going to generate maybe half of the South Sudanese power. So there are also opportunities which are coming with all these challenges, because these challenges and the beauties that are being discussed in almost all forums. So today we are discussing here, there's someone else, any meeting you go to G7, these are issues which are being discussed, and the funds are being allocated for that purpose. And Madam Ruth, you talked about issues of the, the funds which are available to support these initiatives from the SGDs. You see there is a lot of like the EAB funding, all the FDIs are looking for specific areas to support. So banks need to prepare and put in place mechanisms and platforms. Maybe we will need even to review our setup within our banking. Remember, you have this department, that department, but is it really still the same way? Maybe we have to refigure our structure and say, maybe put there climate financing or climate risk department and give it a director. And this guy can be flying to New York, to everywhere, but then they come with all those benefits, because we're talking about sustainability in the next 15, 20, 30 years. We cannot allow to be back. So, Madam, I hope I have.
Thank you very much. So maybe let me just add a little bit to that. I think we are talking about sustainability in the area or in the period of evolving technological advancement, climate risk, economic headwinds, and all that. I think if we are operating in this environment, certainly, and we want our financial institutions to be sustainable, then the sustainability agenda needs to be at the core of everything that we do. It needs to be at the core of the organization's principles and purpose. Otherwise, I think there is really going to be a challenge. I think we need to continue to ask ourselves every day, are we creating organizations that are fit for the future? Are we creating organizations that are sustainable, organizations that are relevant for the future? Which means then, are we investing in the right technology? Are we investing in the people? Are we investing in governance? Are we investing in climate risk and all that? But also I think Professor talked about the climate risk and also talked about it earlier, that it actually also provides opportunity, particularly financing opportunities. So how do we look at that as well? So investing in people, investing in technology, investing in governance, but also ensuring that we have a strategy that is long-term. So which means we don't just look at, I always tell my investors that please, let's stop looking at these quarterly returns. Let's start looking at the investments that we are putting in these institutions to ensure long-term sustainability of these organizations that we run. So I think I'm now looking at the audience, and we still have some few minutes. Secretariat, I think maybe 20 minutes? Yeah, I think 20 minutes. So we are ready to take questions, comments, recommendations, and do we have microphones there? Yeah, someone to help us? Yes, so I think you are welcome. If you have comments, you have questions, the panelists are here to respond to. Please just put your hands up, and someone will reach you with a microphone. Oh, okay. There's a hand at the back.
Okay. Thank you very much, Chair. Thank you very much for a very nice presentation. First of all, let me declare that I'm a beneficiary under the good leadership of Professor Lemma, because I attended ARIC and is the one who signed my contract. Thank you, Prof, for your spirit of building capacity in Africa. It really helped. Secondly, I have a question that during the presentation, Professor Lemma identified some of the issues such as their stochastic estimation, and I was really very interested to see that to what extent, when you talk of efficiency in banks, that the outbreak of COVID-19 perhaps contributed either 2 or 5% to the operation of the bank, from the financial banks. Again, that if you go back to what the Vice President said, that we need to think the possible way of reducing interest rate on loans. And I was thinking that through this discussion, is it possible to connect the fintech with the construction of water well in agro zones in Tanzania? In that case, that we will be fighting the challenge of climate change, where most of the farmers can access water that is sustainable for agriculture. In that case also, it will help again that for them to produce, and the surplus can also be exported, then it reduce the, to fight the problem of the scarcity of forex that is currently facing our country. With those few remarks, I also thank you very much for a nice discussion that has been provided by the panelists. Thank you very much.
Okay, Mr. Frank. Mike, hapa mbele, please. Maybe we take 3 questions, we respond. If we still have time, we will go on as well.
Thank you so much, my sister Ruth, with the moderator today. For me, it's not a question, but just a contribution, especially when we are saying strengthening financial sector, resilience in challenges, challenging economic times. With me working in the agricultural sector, I will try muchly to talk on how banks can assist probably in strengthening the financial sector during the challenging economic times. One of the things that I probably call upon my colleague bankers is to look into the agricultural sector as a very key and probably the enabler for our economic development. Why? Because when we are talking of challenges during economic times, many challenges when they come to people, the challenge when you have an empty stomach becomes a bigger challenge than when you are full in your stomach. And when you say empty stomach, is when we don't have food. So one thing that we need to look into is, one, to ensure that we put more on what we are financing in agriculture. Because in our country, less than 20% has been, everything that we are financed goes to agriculture. But you see that agriculture, especially in African context, is the one which employs more than 70% of our people. Which
one more minute, please.
Okay. So what I am saying is that I call upon my colleagues to put more capital on agriculture. And that's why you saw when we were hit by COVID, the central bank put aside 1 trillion shillings to support agriculture. They never put it to support other sectors. Why? Because they knew if you support agriculture, will stimulate other economies, because agriculture is everything. So if we can really be able to support agriculture, be it the normal production up to agro processing, it will be able to assist us in a lot of challenges, including the forex challenges that we have in the country. But instead of importing, we can now be the net exporters of what we are producing in the country. Thank you.
Thank you very much. So I think maybe, Professor, if you can respond to the first question from your student, and then we will proceed to take other questions. But let me just remind that when you are asking the question, please introduce yourself and then ask the question. Professor? Any comments? Yeah, but don't you want to comment and cement what your student said?
First of all, I didn't really quite get the comment. Yeah. Oh no! I thought it was talking about something. Can I weigh in on the agriculture part?
Yes, please.
Okay. Because I think that comment is really key. You know, with advancing technology, with this conversation going on around the globe about climate and climate opportunity. You know, this is an arena where we can marry agriculture, the other sectors in terms of climate, sustainable agriculture, and entrepreneurship, and startups, and fintechs. So all that stuff that we're talking about in terms of advancing technology and innovation in finance can be anchored in the agricultural sector as well. And it should not be kind of viewed as silo, right? We always talk about transformation, and when you talk about transformation, we always talk about industry, right? Transformation has to occur everywhere. So I really feel that the way we are conducting agriculture tends to be still in the Stone Age, you know. So when it comes to you know, modernization, and it's also an important arena to really in terms of inclusive, you know, growth and development and entrepreneurship. So I think that's very, very appropriate.
Thank you. I think we can pick maybe 2 more questions given time, and then we will respond. Now, okay, there's a hand in the middle there. And a lady, I think we need at least 1 question from a lady. Eh? We cannot finish this discussion without a question from a lady or comments. Abdul Majid, tutaniuliza baadaye, tutajibiana baadaye. Let us give opportunity to the other people who
All right, thank you so much.
Can you introduce yourself, please, and then ask your question or a comment?
Okay, my name is Musa Peter Mwanja. I'm from University of Dar es Salaam School of Economics. My question is, while we are living in the world of full of data, the world which is a lot of gigabytes and zettabytes and full of data are being generated in every second that we're living. How much do our financial institutions in Tanzania making the use of this advantage of data that are being generated, especially in researching? I've been hearing what you've been saying and the discussion and all, and that I didn't hear the part where you say, like, how do our financial institutions, especially banking and non-banking financial institutions, how are they really investing on R&D, research and development? In the world where people are not only rational, but they are living based on sentiments and the news, and they are affected, influenced by the news around the world, how are we making the benefit of reaping the information and researching on the data that are being generated and getting use of them and innovating and covering the information that are hidden in those data? And at the last, maybe we can get the measures or the means that we can help us navigate in those hard time on the period of difficulty. So my question is, how do these financial institutions make the better use of the data, and especially in research and development? Thank you so much.
Next question, 1 more question, and then we will respond. Mr. Cosmas, get ready to respond to that. Oh, okay. There's a hand there, so unfortunately no lady, and we have finished the discussion.
My name is Julius Limo.
Hey, Julius Tena, I saw there's another hand. Okay.
I have a mic already.
Okay, fine. Okay, so maybe 2 more. 1 and then the other person in the middle there. Chapbas.
Thank you very much.
Carol,
Yes, my name is Caroline Yambesi. I'm from CRDB Bank.
be quick, please.
Thank you. My question is, I liked when one of the speakers talked about for every risk register, there should be an opportunities register. But I guess the question that I have is there's a tendency, especially when there's crises. So for instance, right now, there's cyber risks, there's risks of, consumer protection. There's a tendency for banks and to tend to focus more on mitigating the risk and missing out on the potential opportunities that could arise from technological advancements and all of that. And so if I could just get, additional conversation or explanation around how can we manage, how do we reach equilibrium where we're not only dealing with fixing the crises, but thinking 5, 10, 15 years later to make sure that banks are truly sustainable. Thank you.
Thank you very much. So the last one, there was a hand there, yes.
Thank you very much. I really appreciate it. Mine was just to recognize.
Your name, please.
Oh, sorry. My name is Patrick Mususa. I'm from TIOB, Tanzania Institute of Bankers. I wanted to take this opportunity to ask Professor Senbet a question. We don't often see you. We see the other CEOs of the banks. And I note that during your presentation you said that as our economies grow, the talented manpower needs to also equally grow. So I just wanted to know that in your heart of hearts, if you could do one thing to make sure that talented manpower is growing in the banking sector, what would be that thing? What would be that initiative? That's all from me. Thank you.
Thank you very much. So I think Mr. Cosmas, if you can respond on the question on data, and then Professor, you will cover the two questions. One from Carol on what exactly, how can we look at those opportunities, and the last question from Patrick. So Cosmas.
Thank you, Madam Ruth, and I appreciate the question from
2 minutes, please.
a colleague there. I think data is now, I would say probably data is even more than money. Because once you have the information, you can mold it and tilt it and do anything you want with it. So with the interest of time, I will not go into very deep detail. But if you look today, we are operating in a world where artificial intelligence is leading pretty much everything. You will know ChatGPT or whatever, GTP, whatever name they call it. The way things are moving fast now. And so in the industry we are operating, we are actually not on isolation. A lot has been done in terms of harnessing data, and whereas in the Tanzanian market maybe you won't see the publications coming out. But if you go, even in one area where we got, if you talk about the digital financial services, these products we are already offering, the MOBIs, the IBs, what is behind those platforms is a huge amount of data. If you look up these mobile loans, which we are giving, and I know there are a couple of banks which are already doing mobile loans, that activity of harnessing to do the scoring until you get to know which client you will give a loans of this amount and that amount and that amount is all based on data, and that data is coming from the public. And in a way, what we are now seeing, the partnership the banking sector is having with the telcos is because the telcos actually are the ones who are holding the best data when it comes to banking. For example, if we are giving a mobile loan today, this SIM card can help us tell you your consumption pattern, your calling frequency, that is why sometimes you are asked, Salioli Meisha, borrow. It's not because they like you, they know that already you can actually access a loan. So that amount of data which is there is the one we are using. We are talking in many other markets, and I think one platform, one forum within our group at KCB Group, we are talking about establishing a digital bank. So this digital bank, and I know in other markets is already there, is going to be based on that. Now, once you are able to partner with telcos and whoever has data, including NIDA, for example, I know now we use NIDA to open our account. That is all about how we are doing it. it's a moving platform. We cannot say you have it, you're finished. It's continuing to grow. And as I said earlier, the main thing to do with this information is how we are going to build our risk absorbers to be able to allow us to do the right modeling and scoring so that we don't end up into large NPLs. We are doing what we call more loans in one of these countries which I'm leading. It started last year. Huge amount of potential we are seeing there. So we are saying we are using data, we are not there yet, it's a moving platform and it's a growing area. And coming from the university, and I think some other talked about even establishing a platform where we'll use the youth from specific institutions to help us model this. And we will invite you to talk to us. We have TBA chair here. You can side talk with us and see how we can utilize the platform at the University of Dar es Salaam and other institutions to continue to grow our market.
Thank you.
Thank you.
Data is the future. Yeah, Professor, the last two questions, please.
Okay, so this is about talented financial manpower. What I was saying was that as financial systems become more complex, as we have stock markets, and now we have climate finance, things are becoming very complex. And we cannot go on with business as usual. And one of the challenges that I faced at ARC was it was too macroeconomically oriented. It had very limited capability. I tried to bring up capabilities in finance. Right? So there's a variety of ways. One is, as banks, as institutions, banks, should really partner and help strengthen finance curricula at universities. You should, I think you should really, first of all, by the way, we have a governance forum at ARC, and Bank of Tanzania is the founder. We had 12 central banks that convened, right, to enhance the analytical capacity in finance and risk management. And the other is that there are positive externalities, not dependency. For instance, this new U.S. Biden Africa Summit leadership, it puts a lot of emphasis on self-reliance in Africa, and also on digital transformation, on issues that I'm talking about. So really, instead of going to those guys and asking, give me money, ask them to actually provide technical assistance so that you'll become internally capacitated right in this country. And then, by the way, G20, I serve on G20 Compact Advisory Panel. The same thing. They do have resources. Use outside resources to empower internally, and then also do internally. So, so I think together you should be able to do that. By the way, there's no choice. You know, talented financial manpower is an economic growth phenomenon, right? So, and then I don't know the extent to which you are actually partnering with the universities, University of Dar es Salaam or Arusha, or helping build finance. Yeah, thank you. The second question.
On risks and opportunities. Yeah, so how do you spot the opportunities from Carol?
Okay, I think what she was talking about was the balance, is that right? So when we have a crisis, we're actually trading. The immediate reaction is, how do we mitigate this? How do we try and get out of this, right?
Or Mr. Philip. Mr. Philip, you talked about the risk registers and the opportunities. So maybe you are the best person to actually respond to the question, please.
Yes, I did that. Thank you. One of the things that I know banks can look at, for example, issues of technology that we are talking about. We have seen, and I think it's also the same in this market, that banking institutions now have seen the significance of ICT and the importance of being innovative and so forth. And they've established innovation hubs within the market. But what we're also seeing in Zimbabwe is that there's now a trend where I think now we have about 4 or 5 banks. They have established ICT companies as part of the, as an affiliate, there's a holding company, established an ICT they've been very aggressive. One of the banks is NMB. It's very aggressive. They are reaching out the region and they are innovating, and we are seeing issues of robotics there and so on and so forth. So that's one opportunity that has been created by the crisis where we're coming from. We also been interacting with the banks. There's issues of, you know, when you go out, we have our municipalities that are struggling to clear litter within the cities that we stay in. But they are looking at those cities as just potential borrowers. But because they have weaknesses in terms of capacity, they are not willing to, you know, assist them. But we say to some of them, look at them, how do you come in and assist in the waste management? And in the process, then create the much needed, you know, clean energy. So, you know, you have something that is looking like a risk, but on the flip side, it's an opportunity. So some of them are taking those things up, and gladly so. I think they are also, you know, making headway. And then if you allow me, Chair, just to comment on the issue of agriculture. That was, so in the market where we are, we have one or two banks that are clearly focusing on agriculture. So there are things that we ask the CEO, Mr. CEO, are you a believer in the force of agriculture to transform the Zimbabwean economy? If the answer is yes, then we then ask them, how can your bank be part of that coalition, leadership coalition that is transforming the bank? How can your bank be part of that force that will lift Zimbabwean people from hand to mouth, you know, subsistent farming to farming that is commercial, you know, and viable and so forth? How can you come in to modernize the agricultural sector? How do you fit in the agricultural value chain? How do you come in to support technology so that technology, you know, transforms agriculture in terms of smart, you know, approaches and so forth? So that's how we also have been dealing with banks, and we've seen that banks have now relooked at how they want to position themselves, what they want to do in terms of their assisting agriculture.
Thank you very much. Ladies and gentlemen, I think we have now come to the end of this discussion session. I think, oh, Prof, you still want to talk? Mic, please, to Professor.
Prof, I'm already here, just so you know.
Okay, yeah, thank you. Can you? Yeah, somebody mentioned capital flight. Okay, I'm kind of tempted to mention something, which is another huge opportunity. So I had a major study done at ARC on capital flight from Africa, right? And you observed two things. Okay? Basically, over decades, trillions of money has been kept out of Africa. And you think that it is all stealing or theft. But a lot of that happens through multinational corporations. You know, profit shifting, transfer pricing, and I often say that these multinationals are actually domiciled in G20 countries. So every time we have this G20 conference, we are kind of pushing this on their agenda. Because I think working on the reversal of capital flights, and then remember today I was talking about debt. Actually, if you take that into account, Africa is net credited to the rest of the world. Okay? So this is a huge, huge space. I think that Tanzania should play an important role in this movement. And we have outside movements. I think it's really important. I just wanted to mention it.
Thank you, Prof. We hear that. Thank you. So ladies and gentlemen, thank you very much. This is the end of this panel discussion. And I thank the main speaker, but also all the panelists. And I believe that we have all, you know, picked key learning here that we will use to ensure that our financial institutions continue to remain sustainable and exist for a long term in this country. Thank you very much, and thank you for the opportunity. Asante.
Let us give them a big round of applause. If I may request you to kindly stand up and just stand at the front. Where are my camera people? The camera person, we want to take a picture, and as they take a picture, let's give another warm applause to Madam Ruth for that wonderful moderation. Ruth, do you want to come in the middle of the gentlemen? Yes, that's a beautiful picture. There's my cameraman, and as we take a picture, hoping that we had a fantastic time. Did we have a good time today? Did we enjoy this discussion? Excellent. So we need to move from the conference to putting everything into action. Dear Governor, distinguished participants, we've come to the end of day one. Can we put our hands together for all of us for active participation? Tomorrow is an equally interesting time. We're going to start at 8:30 in the morning. So we be here by 8 o'clock. We are finishing morning today, so tomorrow there will be a lot of music and dancing. We shall start at 8:30 in the morning with the financial sector stability in the wake of economic crises, regulations, innovation, and risk management. This is panel discussion 2. We'll start this at 8:30, so if you can be here by 8 o'clock and take it through by 8:30. And then we are going to have a wonderful session this evening, and to tell us about the session this evening, allow me to invite my co-host, Madam Beatrice. Oh, there she is. A round of applause. She's done a tremendous job. Asante sana. Beatrice, what do we have tonight?
Thank you so much, Mr. Makani. Honorable Governor, distinguished guests, I wish to inform you that the Governor Bank of Tanzania, Mr. Emmanuel Tutuba, is cordially inviting you tonight at the Mount Meru Hotel for a gala dinner that will be held from 6 p.m. So you're all warmly welcome. Please be there on time, and the dress code for the evening is smart casual. You're all welcome.
So until tomorrow, let's all meet in the evening for the gala dinner. Thank you, Governor, for that courteous invitation. Niwatakie wote jioni njema na tukutane kwenye chakula cha jioni. Asante sana. Nashukuru.